Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Martin Fraenkel, Chairman of the Board of Directors at VAKT Global Limited and Senior Advisor to Independent Economics. Martin, thank you so much for joining us today.
Well, my pleasure, Diala. Let me say that, as we were just saying, it's International Women's Day today when we're recording, so I'd like to congratulate you on your pioneering career and your colleagues on the team here.
Thank you. Thank you so much for that. Let's start by talking about, so we're approaching the end of the first quarter, and I wanted to get your views on whether you think the Brent, crude and commodities, the oil and commodities markets in general, have gone as you would have expected at the end of December, and what's your outlook for the second quarter, and what are going to be the key factors influencing the direction for oil and other commodities?
Well, look, Diana, I think that Brent and the oil complex the crude oil complex is in a range, a broadish range. They're ample spare capacity, particularly in the OPEC Plus and with the Saudis, and it seems that some of the new production continues to be able to crank up. So I think we don't have huge risks to the upside this year. That said, you have to caveat by the fact that if anybody had told any of us some years ago that you could have all the geopolitical disturbances which are going on in the world at the moment and crude oil not really be doing much in terms of reaction, we'd be pretty surprised. So there's always a risk that we're getting complacent.
Okay, absolutely. I mean, on that sort of risk premium, if you like, that we haven't really seen play into the oil price, maybe a little, $2-3, but it hasn't really pushed beyond that, and continues, as you said, to be steady. Oil prices have been pretty steady for the last 2-3 months, especially as we've seen, sort of increased sort of activity in the Red Sea area, let's say on shipping and vessels, etc. I mean, do you expect that equation to change, or do we have to see a disruption to oil supplies to really find the equation on the oil price changing this year?
I think we need to see that actual disruption. Yeah, I think that markets have largely discounted that the overall situation in the Middle East can translate into, 1970s styles boycotts of production and things like that. So I think we would need to see real disruption, including, potentially attacks on production facilities, which obviously we've seen in the past in Saudi, for it really to impact the oil price.
Okay, and hopefully that won't happen.
Definitely, hopefully not.
Yeah, absolutely. I mean, let's stick to sort of the oil price, but also other factors that are influencing. And of course, demand is a big one, not just potential supply disruptions. Demand, Chinese demand, let's focus a bit on that. Clearly, a very big driver of crude demand and prices. We saw China come out with its forecast for 5% growth, planning target of 5% again this year, as it did last year. How much confidence do you think the oil market is placing in the Chinese economy to be a consistent and reliable sort of source of demand, if you like, this year?
Well, I think that first of all, let's take half a step back, Diana, and let's get the context that demand was extremely strong last year, and we've got record global levels of oil demand. So that's the context to begin with, which I always feel is useful to restate, because with all the discussion around energy transition, we forget, or you and I and many people don't forget, but popular sentiment, if you like, forgets that we're actually at record levels of global oil demand. So I think that's the context. China demand went up last year as the Chinese got moving again and industry started picking up, but probably not quite as much as some of us expected. And I think for this year, there clearly are significant issues in the Chinese economy, and they're probably larger than we've really got a a handle on at the moment, because obviously the transparency is not there in the same way as it is in some of the Western economies. But as the signs grow that there are issues in the Chinese economy, that becomes more and more concerning. And I think that in years gone by, there was a high degree of confidence in markets in general, and certainly in the oil markets, that the Chinese government would deliver on its economic targets. And I think that confidence is gradually being eroded.
Mm-hmm. Well, let's talk a bit about U.S. economic targets, let's say, or let's say the U.S. economy. I mean, clearly that is also going to have a big influence on demand in general. A big consumer also of oil, and producer as well, of course. But where is your sense of the economy of the U.S. surprising many people, perhaps that it did much better last year than expected? Rates are now higher for longer, steady. More predictable, perhaps, where we're going with that. Are you as confident as some other people that we are not going to see a recession at all in America, and that these rates are not going to trickle through to manifest on the ground?
I'm pretty confident. Yeah, I mean, I'm not a professional economist, so I'm probably not necessarily the best person to ask that question to. So, if you like, my viewpoint on that is a sort of a common sense viewpoint. But it seems to me that that if there was going to be a recession, it would have been last year, and as you say, it wasn't. I think the one risk which seems to me to be growing in the U.S. economy is that stock markets and financial markets are very strong, as you know, and largely on the expectation of rate cuts. And there are some signs that the Fed may not cut as quickly as markets are expecting. So it doesn't feel to me like we are in bubble territory in terms of US equity markets, but they're very much led, as you know, by the seven big tech stocks, the Magnificent Seven, as they call them. And so there must be a risk that if we get disruption in equity markets and in some of those big stocks, that could have a trickle down effect on the economy as a whole. But I don't really expect that.
Okay. And I mean, while we're on the topic of economies, just again, what's the vibe in Europe? I mean, you're based there in London. European economy wise, in terms of even demand for gas, for oil, activity, manufacturing, is it looking better or worse than 2023 in your opinion?
I mean, I think it's better in the sense as we're having a second very mild winter in a row. Arguably concerningly mild winter. I think they're saying that spring in London is a month ahead of where it is on average. And if I look out of my window, I'm fortunate I got gardens in the background, and you can see the cherry blossom already starting to bloom. So, we definitely have had a mild winter, but two mild winters in a row have obviously helped the situation in terms of gas and gas storage. And in that sense, if we were going to have mild winters, it was a good time in terms of the transition away from Russian gas. So I think those pieces are positive, and the risk of really serious disruption to European economies from the transition away from Russian gas and to some extent oil. I think that's been averted, and as you know, there's now good supplies of LNG coming into Europe. So I think that's all the positive piece. I think the negative piece is that if you look across Europe everywhere, growth is very slow, and that there are too many economies where there's been really very little growth in the last 15 or 20 years. And so that's building year upon year. It seems to be a structural problem in Europe, and it seems also to be building the political tensions in Europe. And I think that those are warning signs.
Okay, and you mentioned Europe, transitioning away from Russian gas. Has been getting increased supplies of LNG from the US, from elsewhere. Do you think there's any scenario where we would see Europe go back to taking Russian gas? Let's assume the Russia-Ukraine war ended next month. which it's not going to. But would you see Europe perhaps going back to that reliance, at least partially, or have we learned our lesson, if you like, in that sense?
I don't think Europe goes back to reliance. I think economics and cost is always a powerful driver in international markets. So I think if the situation were to stabilize, i.e., a ceasefire which was acceptable to the Ukrainians, and probably in a post-Putin era. Then personally, I would expect that yes, you would see Europe starting to take gas from Russia again because the economic drivers are so strong. But I don't see that happening in the next year or two. No.
Okay, Martin, I wanted to ask you about sort of the US again, LNG. Let's touch on gas because, and of course, we're looking at an election year in America. What would you see as the main differences, whatever the outcome might be, if we get Biden versus Trump presidency come November, what's the main impact on energy policy, if you like? Obviously, you have the IRA bill that's been a big success for Biden. Would Trump not continue that, considering it's America first, American manufacturing, nearshoring, all that? Where do you see the main differences in energy policy?
I'm tempted to say, who knows, right? It's a bit of a random walk, that one. I think the differences are actually going to be pretty significant, but there's a lot of guesswork involved in this. Trump has made it pretty clear, I think, that he will go further and harder down the sort of US isolationist trade protection type of route. So I think that will likely happen. He clearly is at best a climate change skeptic, and clearly would not be an advocate of the types of measures such as the IRA, which the Biden administration has pursued. And we saw in the Trump 1 administration that, partly how he identifies himself and his administration is being against things which the previous administration has done and which he perceives as being not popular with his base. So I think it's quite possible that he will go after things like reversing or at least destabilizing the IRA, reducing subsidies, those sorts of things. So I think that's quite likely. I think it's quite likely that that there will be more import tariffs on different forms of raw materials coming into the US. And I think it's equally likely that, as you know, the Biden administration, which is a little bit schizophrenic on this issue because it wants exports of oil and gas for the geopolitical situation, of course, for the US economy. But on the other hand, it doesn't want growth in US oil and gas production because of its own domestic base, and I think genuine concerns about climate change. So I would imagine that a Trump administration, if it were to happen, would probably roll back things like the restrictions which Biden has just introduced on new developments of LNG exports in the US. So I think the tone would be very different as far as the energy sector is concerned, albeit that, the Biden administration's actually been pretty benign towards the hydrocarbon sector in North America. And we have very high oil production, as you know, and gas exports.
Absolutely, and that's particularly last year that took quite a sort of advanced quite a bit. We had the M&A activity as well, quite a bit of that. Let's talk a bit about sort of big oil in America, but in the context of also European majors as well. I mean, we've got the valuation story of how the Shells of this world saying why can't we be valued like as if we're listed in America, etc. But and some backtracking by the European majors on their energy sort of transition commitments, I suppose, or at least targets. What is the comparison today between the US and European majors in terms of their journey to support the energy transition? Clearly, we have companies like Exxon, etc., who have never said that they will be doing that. So where do you think that's going, that story?
Well, I think you're seeing an increasing bifurcation, really, Diana, between the US majors and the European majors. I mean, it's clear that the US majors are all in terms of maximizing their production of hydrocarbons and consolidating particularly in the Permian Basin in the US. By the way, from a carbon perspective, and this is probably a slightly heretical statement, but I'm not sure that that's necessarily going to be a bad thing from a carbon perspective. My own viewpoint, for what it's worth, is that one of the ways in which we're going to get significant reductions in carbon emissions is by carbon capture and storage and other measures to reduce the carbon footprint of the existing hydrocarbon production in the world. So to do those sorts of things, economies of scale count. And I think there's a reasonable chance that, over the next few years, we may see that the consolidation in the Permian Basin in Texas means that you do get the US majors pushing forward with that type of technology and investment, because they also need to have, what's now increasingly called the social license to operate. And I think companies like Occidental Petroleum have gone quite far in terms of pioneering those technologies. So I think we may see some of that in the US. We see some of that in Europe, and there's a very ambitious plan which in the North Sea, which the UK Transition Authority, the government authority, has helped facilitate around carbon capture and storage facilities around the oil and gas production facilities in the North Sea, and eventually with wind helping to power all of that. So I think we're seeing some of that in Europe as well. But I think that the pressure on the European majors to show that they are moving away from hydrocarbons and that they're developing and that they're investing in renewables projects is clearly significantly higher than it is on the US majors.
Okay, and I mean, what about capex then? Investment on upstream, so conventional. We're talking about, yes, continuing to invest in those new technologies to clean our conventional energy, but what about upstream? Continuous investment in upstream. We obviously see this part of the world in the Gulf that's continuing as on track. Obviously also with investing in these cleaner energy as well. But do you see that also continuing in a big way in terms of US and European majors? There's been a lack of capex in general, hasn't there? So, but those companies have had a pretty good run in terms of revenues. So, do we see that shifting, that needle shifting?
I think what we're going to see over time is that the financing of hydrocarbon projects is going to move more and more into, for want of a better word, I would call non-traditional sources, right? So we've seen some of the traditionally big leading hydrocarbon finance banks, people's like Barclays, JP Morgan, Standard Chartered, others, sort of signaling that they're going to be not necessarily exiting the sector, but quite cautious about it, and they're monitoring it, and it's a question which they're looking at very senior levels in their banks. So I think we're going to see a shift away from them. But as you say, the banks in the Gulf and in Asia and in China are very willing to finance these projects from what I understand. So I think that we will see projects certainly outside of the G7 countries, if you like, getting financed. But of course, like always, it's easier to finance in a higher price environment and when the returns are better than it is in a lower price environment. So we sort of forget that we had a few years up until sort of the really through the pandemic of quite low oil prices, and where, obviously during the pandemic, we even had negative oil prices at one point. So, that was a period of considerable uncertainty in terms of the future. So that obviously does impact the ability to raise capital for new projects. So I think it's something to watch, and it's probably something particularly to watch in terms of new exploration in the US, which, as you know, is now, I think I'm right to say, the biggest hydrocarbon producer in the world, right? So whether that can sustain itself in the same way, I think is probably a question mark.
Okay, but we have seen, you're saying that, that there is a withdrawal or more of a caution from financiers in terms of upstream financing. But we have also seen in the last year or two, post-COVID, as we sort of had challenges with supply chains and everything else, and we had the Russia-Ukraine war, the ESG sort of label, ESG investing, has taken a bit of a rap, hasn't it? I mean, what direction are we? And of course, that doesn't just impact the energy sector, but that judgment of ESG in terms of finance, are we seeing a little bit of a backtracking on that?
I think we're seeing a little bit of a backtracking, but I don't think it's going away, would be my take on that. I think, like a lot of these trends, I almost said fads, but I don't think it is a fad, trends, that maybe it got a little bit overheated, and maybe that there was a little bit of oversimplification in terms of what ESG investing was about. And I think we're having probably a sensible rethink about what is ESG investing, and why do we do it. My own view is that some of the claims which were made about ESG investing were probably exaggerated. Some of the suggestions that, that companies which are ESG compliant and doing that have better returns and things like that, I think that the evidence to support some of that was often pretty thin. And probably there are some disappointed investors around that. But I think that I think some of the metrics for measuring some parts of the ESG investment market are still unclear, and maybe not rigorous at best. But I think the general topic is a really important one, which is not going away. So I think that's why I would say that we're having a bit of a recalibration, and my expectation is it will come back in a different way. And personally, I'm a big believer in transparency and people knowing, what companies they're investing in and what the policies of those companies are. And I think if we can move towards transparency and more publication around ESG metrics, then that would be very positive.
Okay, and of course, I mean, one metric that's still working itself out is also carbon pricing. We have, I mean, let's talk a bit about COP28 and what came out of that. Many things. One was the statement which, for the first time, mentioned fossil fuels. There was the methane reduction commitment made, but still we have sticking points on the world agreeing on carbon pricing. We have voluntary carbon market, but what do you think were the main sort of takeaways from COP28 that were positive, and what's yet to be resolved from an emissions point of view and the instruments being used to tackle those?
Well, I think the statement about methane reductions was very, very important. My understanding from people who are more familiar with science than I am is that, one of the areas where we can make very rapid progress in terms of emissions reductions is by controlling methane emissions, so which are more potent than carbon emissions. So I think that was a very important and possibly underestimated statement. I think the press coverage over COP got very hung up on whether there would be a statement to eliminate hydrocarbons or reduce hydrocarbons or whatever. And to be honest, those things are headlines rather than meaningful, because it's going to take decades, right? So I think the methane reduction statement was very important. And I think also, I gather this week there's been the launch of a satellite which is going to track in real time what methane's emissions are around the world, can identify them from space, so to help the emitters to shut them down as soon as possible. So I think these are really important and substantive advances which are being made. So I think that there's this sort of slightly two-track approach which is coming along here between people on the ground, including in the leading hydrocarbon companies, who are now starting to take really meaningful steps and taking these issues seriously, and the public, if you like, sentiment around this and some of the headlines, which is quite different.
And what about voluntary carbon markets? Do you think they're working transparently? Of course, there's a lot of commentary about greenwashing, etc. Are they a fair system? I mean, that's what we've got at the moment, isn't it? Voluntary, and not a sort of comprehensive global one. Where do you think there's work to be done there?
Well, I'd caveat that slightly, actually. I mean, I'll come back to the voluntary carbon markets in a moment. I mean, I think that what we've got around the world, we certainly don't have a global carbon price.
No.
I do believe that a global carbon price would be extremely positive, because essentially the whole carbon issue is around pricing what has historically been an externality from the production of hydrocarbons, in economic terms, an externality which has not been priced and which there is a significant cost to. So if you can put a price on that and integrate that into the cost of producing energy, then that would give a lot of very important market signals. So I do think a global carbon price would be important. It doesn't look like we're going to get one. I think it's very unlikely that we're going to get one, given the geopolitical situation and the reluctance of probably particularly the US and China ever to agree to an environment in which their energy needs were subordinated to some sort of global authority. But I think that what we are gradually seeing is parallel carbon prices emerging in each of the three major carbon emitting areas in North America, Europe, and in China. So I think that is positive. As far as the voluntary carbon market is concerned, I think the voluntary carbon market is a sort of, in that sense, a nice to have rather than a got to have. It's much more important, in my opinion, that carbon gets integrated, or the price of carbon gets integrated into the overall price of energy, then that we have effective voluntary carbon markets. I think there are still clearly some issues in voluntary carbon markets, but that they continue to gradually make progress.
Martin, I'm going to put one more question to you before we wrap up, and it's not something I expect a precise answer to, but if you were to give me an average price for Brent this year, the way things are going, taking into account whether we think it's going to be a more or less volatile year in that sense, would you say we're going to have a predictable band? Are we going to stay in the 80s, or all things remaining equal? What would you put your money on?
Well, I predict a wide band. That way I'll be safe. So I think we'll be in a $70 to $100 band.
That's too wide.
If we go outside that band, but it's not impossible. If we went outside, it would be to the upside rather than the downside. But probably the band will be significantly narrower than that. So my guess would be it would be for Brent a $75 to $90 band, and at the moment it looks like that will be a fairly stable band, with plenty of spare capacity in the background. I mean, obviously, some of that will depend on what OPEC Plus do in the middle of the year and the Saudis do in terms of whether they are willing to continue to hold back production or not.
And do you think that they will do whatever it takes to keep prices where they are today, assuming that's in their control? Is this a comfortable level for them?
I think it's a comfortable level for them. It's not an ideal level for them, but I think it's a comfortable level for them.
Martin Fraenkel, Chairman of the Board of Directors of VAKT Global Limited, thanks so much for joining us today on Halftime Talk. It's been great to have your views.
Thank you very much. Nice to see you.